Most people think inflation is something that happens to the economy. It's not. It happens to your life. It shows up slowly. In groceries that cost a little more than last year. In rent that quietly increases. In insurance premiums that never seem to fall. Nothing dramatic, no crisis, just a gradual shift. And that gradual shift is powerful, because money that sits still does not stay equal. If your savings earn nothing, while prices rise 3 or 4% per year, you're not preserving wealth. You are surrendering purchasing power, quietly, year after year. That is why inflation matters, not because it shocks you, but because it compounds against you. And that is why inflation is often called a hidden tax, because it extracts value without asking permission. People respond emotionally. They complain about grocery prices. They blame governments. They blame corporations. They feel frustrated. But frustration does not protect purchasing power. Ownership does. There are two types of people in an inflationary world: those who consume assets and those who own them. The difference is everything. When prices rise, businesses do not panic. They adapt. If raw materials cost more, they raise prices. If wages increase, they adjust margins. Here is the key. Strong businesses, especially dominant ones, can pass inflation on to customers without losing them. The overall system adjusts. Capital flows toward strength. Weak players fall away. That is how markets function. Now consider something important. If companies are raising prices, maintaining profits, and growing earnings over time, who benefits? The owners, the asset holders, not the consumer, not the person holding idle cash, the owners. Inflation quietly punishes savers who hold only currency, but it often protects and sometimes rewards those who own productive assets. That is the quiet divide. Let's make it simple. Two people. Same income, same discipline, same work ethic. One keeps everything in a bank account, earning almost nothing. The other owns a broad collection of productive businesses through index funds. Time passes. Groceries cost more. Rent rises. Insurance premiums increase. The saver feels squeezed. Every dollar buys a little less. Now look at the owner. Company revenues rise with prices. Earnings adjust upward over time. And over long periods, stock prices tend to reflect those rising earnings. The businesses adapt. The value compounds. The owner's assets expand with the economy. The saver's purchasing power shrinks. Both are responsible. Both are trying. But one owns pieces of productive engines. The other holds currency that slowly weakens. In an inflationary world, the advantage goes to those who own businesses that can adapt. If you do not own productive assets, you are depending entirely on income to outrun rising prices. And income alone is rarely enough. The system does not reward effort by itself. It rewards ownership. That is the lesson. Not fear, not prediction, just positioning. Wealthy individuals understand something very simple. Cash is for liquidity. Assets are for growth. They do not hold large amounts of idle money for long. They convert excess cash into productive assets. Businesses, real estate, equities, ownership. Because ownership adjusts with inflation. Cash does not. Now, this does not mean you avoid cash entirely. That would be irresponsible. Cash has a purpose, an emergency fund, short-term needs, flexibility. But long-term wealth cannot live in cash. It must live in assets. And ideally, in assets that produce value for society. Because those assets will raise prices when the currency weakens. There is another layer most people miss. Inflation does not just affect prices, it changes behavior. When people feel prices rising quickly, they rush, they speculate, they chase whatever seems to be beating inflation. Gold, crypto, real estate at any price, trending stocks. They confuse motion with protection. But protection is not found in panic. It is found in ownership of durable, productive systems, the kind that generate profits regardless of headlines, the kind that have pricing power, the kind that survive decades. Inflation comes and goes. Strong businesses remain. So what should the ordinary person do? Not speculate, not panic, not hoard. Instead, increase earning power when possible. Control lifestyle inflation, own broad assets, and remain consistent. Inflation is dangerous when income stagnates and assets are absent. It becomes manageable when income grows and assets compound. There is a practical framework here. First, eliminate high-interest debt. Because inflation working against you at 20% interest on a credit card is devastating. Compound interest does not care about your intentions. It works relentlessly in both directions. Second, build a safety buffer. 3 to 6 months of expenses. This prevents you from liquidating investments at the worst possible time. Third, invest consistently in broad, low-cost index funds. Why index funds? Because they represent ownership of the entire productive engine. When prices rise across the economy, those businesses adjust. You own the adjustment mechanism. You do not need to predict which company wins. You own the system itself. And over long periods, that system has historically outpaced inflation. There is another behavior that separates asset owners from everyone else. They ignore short-term noise. Inflation numbers spike 1 month. Markets fall. Headlines scream. Panic spreads. But disciplined investors continue because they understand something fundamental. Inflation is not defeated in a year. It is defeated over decades of ownership. Trying to outmaneuver every data release leads to errors. Owning productive assets and allowing them to adapt is simpler and, historically, more effective. There's no dramatic answer to inflation, no secret hedge, no magic trade. The wealthy do not beat inflation with clever tricks. They beat it with structure, ownership, patience, and rational behavior during volatility. They understand that currency weakens. But productive assets adapt. They position themselves accordingly. Inflation has appeared in every generation. Currencies fluctuate, governments change, markets cycle. But ownership of productive enterprises has endured. That is not ideology. It is economic reality. So the question becomes simple. Are you holding paper that loses value? Or are you holding assets that adjust? Are you reacting emotionally to rising prices? Or are you positioned to benefit from the economic engine behind those prices? Inflation is silent. But your response does not need to be. You do not fight inflation with fear. You outgrow it with ownership. Over time, the difference becomes visible. The saver sees higher prices. The owner sees higher earnings. The saver feels squeezed. The owner sees expansion. Both experience inflation. Only one benefits from adaptation. Inflation will not disappear, but it does not need to control you. Position yourself as an owner. Maintain discipline. Avoid lifestyle excess. Invest consistently. And allow time to work in your favor. Because while inflation quietly taxes the unprepared, compounding quietly rewards the patient. And in the long run, quiet forces are the most powerful of all. Thanks for watching.